give us an overview of what the infinite banking concept is. And then Blake, you get a chance to kind of fill in whatever Rod misses.
Okay, so I'm going to start at the beginning with Nelson Nash. And basically what he did is he said he knew whole life really well, how to build it, how to overfund it, how to get the most into the cash value so that then you could use it. And he said, okay, well, if I'm going to use it for anything, I might as well use it for everything. So in other words, I put money into my policy, and then I'm going to take loans against my policy to, again, do everything. I'm going to pay my bills. I'm going to buy my cars. I'm going to go on vacations, all of this thing. And it's better because if instead I'm taking my paycheck and setting it into my checking account and then paying my bills out of that, well, the checking account is inefficient compared to the growth that we can create, this 5+% tax-free return that I can create in the policy as a starter. And then secondly, when I loan against it, I'm creating an interest rate arbitrage. In other words, the interest that I'm paying on the loan is lower than the interest that I'm always earning inside of my cash value of my policy. And so even if it was just the fact of having a loan against my policy, that by itself is creating more wealth for me because of that interest rate arbitrage.
Basically, everyone knows if you're financing something, you're going to pay interest on that. But on the flip side of the coin, if you pay cash for something, let's just take a car, for example, you go pay $30,000 and pay cash for that. The cost to you is not just the $30,000 that you paid for the car, but also what that $30,000 could have grown to had you not paid for that car in cash. So there's financing costs, whether you're paying interest to someone else, but there's also that lost opportunity cost of what your money could have grown to if you spend cash now.
Talk about the connectivity of infinite banking to lost opportunity cost.
Yeah, I mean, if you're using that inefficient checking account to capture your money and then pay your bills, you have days of each month between. So if you get paid on the 5th of the month, and that money lands in your account, but you don't spend that money, your mortgage doesn't come due until the 25th of the month. You have 20 days of that $1,500, $2,000, whatever your mortgage payment is, where it's just sitting there earning next to nothing. Whereas if instead you take that money and you immediately drop it into your life insurance policy, where now it's earning the guaranteed interest and creating this compounding growth now and forever, you're now capturing something. So the example that Blake gave, I'm instead of not earning anything, my opportunity cost, if I use the checking account, is that I'm not getting that 5+% tax-free growth on that money for the 20 days to begin with. And then when I do pay my mortgage, I take a loan against my policy to pay the mortgage, but because my cash value stays complete, I loaned against it, right? I didn't take that money back out of my cash value. It now stays there and continues to grow and is creating this interest rate arbitrage because we're always paying less on our loan than what we're earning in our cash value.